Though Thanksgiving 2016 is now past, and we hope you had a great holiday, it's not too late to be thankful for the very excellent economy we're experiencing. The U.S. economy puts before us a feast, so much for which we can be thankful. With the election of Donald J. Trump as the 45th U.S. President, shares in U.S. companies have broken through to all-time high prices never reached before. Share prices in the S&P 500 are trading at about 18 times the trailing 12-month earnings, right in line with historical valuations, and the outlook is bright. To be conservative, the dotted line shows the trajectory of the S&P 500 if shares were to trade at just 17 times earnings, lower than the recent multiple of 18. This is not a forecast or prediction. It's a calculation, illustrating a path that the S&P 500 could reasonably be expected to take given the current outlook for economic and earnings growth and low inflation. It paints a pretty picture of what we may be heading for. Stock market sentiment could change at any time, and you don't want to count profits before they are realized. However, unless something unexpected and bad happens, which is always possible, that's the direction in which stocks will be pulled. When oil prices collapsed, earnings of the S&P 500 plunged in the period from September 2014 to the end of 2015. While energy and raw materials companies of all kinds represent 7% of the S&P 500 market capitalization, the severity of the drop did not affect the entire S&P 500. The red line shows how the oil price collapse was much less severe for the 93% of the S&P 500 index that are not in the energy or materials businesses. With the passing of the third quarter of 2016, the last downward revision in expected earnings occurred over a year ago and is no longer factored into the earnings forecast. Suddenly, expected earnings through 2017 have soared. As of Thanksgiving 2016, the earnings growth trajectory through the end of 2017 is about 10% year over year. At 89 months, the current expansion is neither young nor old compared to the previous growth cycles since World War II. With average hourly wages rising amid dormant inflation, the Fed is unlikely to tighten credit and make a mistake that slows the economy and throws it into a recession. That's how most expansions end. Recessions trigger bear markets, but not every bear market was accompanied by recession. Stock prices are liable to bounce up and down by 10% or even 15% because of changes in sentiment, so you have to always expect volatility. However, the fundamentals of the economy are strong. This expansion could go on for many years, and it is not showing any signs of ending. With all the concern recently about fake news, our firm is dedicated to being a source of authoritative analysis of financial and economic fundamentals, which is why this weekly report is being shared with you. With that in mind, we could not let Thanksgiving pass without reminding our clients and friends that there is indeed much in the U.S. economy for which to be thankful.